Welcome back after the break. We are going to have a discussion on a topic which has been a cause of concern, especially for lenders for past many months. Reserve Bank of India has now released final circular on project financing norms. While the draft circular had proposed 5% provisioning, the final circular mandates 1 to 1.25% provisioning, that is standard for lenders. To discuss this matter in detail, I have with me former Chairman of State Bank of India, Mr. Dinesh Kumar Khara. Mr. Khara, welcome to ET Now, and what a day you are joining in. 16 years we have completed and you have been part of that journey. My first question to you is, will these norms now, which is a kind of relaxed in a manner for lenders, be enough for risk recognition?
First and foremost, RTS, congratulations on completing 16 years. Well, when it comes to these norms, of course, they are quite favorable for the lenders. And at the same time, while doing so, it is certainly a departure from the past. So which actually means that it is actually trying to strike a balance between the risks which are inherent in the project finance notes and also ensuring that the balance sheet should remain intact and also strengthened over the period of time to take care of any potential risk which might get unleashed in these project loans. So I think it's a very, very pragmatic approach which has been taken by the regulator, and in terms of ensuring that the burden should not be excessive, because this is a point of time when perhaps when it comes to infrastructure, it is going to be a major lever of growth for the Indian economy. And it is certainly not in the interest of the economy or in interest of anybody else to derail this whole process. And I think keeping all that in mind, very well thought of provisions have been introduced, which are quite balanced. So, which actually takes care of the risk also, and also ensure that there is enough pragmatism in terms of whatever norms are being introduced.
Mr. Khara, in the draft norms, 5% provisioning proposal was there. When these norms were presented, the idea was that there is enough risk to take that kind of provisioning. What has changed from then till now? And more importantly, do you think this 1% provisioning or 1.25% provisioning will be enough for the risk which banks are taking?
See, I'm sure even RBI and also various banks also would have made a representation to Reserve Bank of India, detailing therein what has been their past experience in terms of these project loans. And I'm sure all that must have been looked into while arriving at these kind of regulation. So I think, to my mind, because in the past, if at all we will look into the history of project loans, maybe about 10 years back, there was a massive challenge. But yes, of course, if at all we look at just about 5 years back, how things were and how really things are really moving on. So I think to that extent, there was enough discipline which has been brought in as far as the lenders are concerned, and also likewise from the borrower side also, there's enough discipline. And similarly, all stakeholders are quite mindful in terms of ensuring the timely completion of the projects. So I think these are some of the changes which have happened, and it must have been brought to the notice of the Reserve Bank of India. And based upon the data which would have been furnished, this kind of a decision would have been taken. This is what my understanding is.
Current norm says that operating phase provisioning for non-CRE projects is now just 0.4%. Will this give headroom for banks to chase these kind of projects and refinancing now?
See, the point is that more than the refinancing, this actually, when it comes to the new projects which will be underwritten, and from the month of October onwards, there the new norms will be applicable. And because as far as, so which also means that when it comes to the pricing of these project loans, even this kind of additional provisioning which has happened from 0.4 to 1%, even that will also get factored. So I think it's not the rebalancing of the portfolio or the repricing of the existing loan. But for the new loans, there would be enough elbow room which would be available, considering the fact that we are into the down cycle as far as interest rates are concerned. So there would be some elbow room to factor in the additional cost which would be there for increased provisioning.
So overall, do you think the credit flow will improve, which is the idea of these provisions now?
Yeah, I very well, because the past, when the 5% was proposed, that was expected to be a big dampener for the project financing. But I think with this 1% kind of a thing which has been brought in, there will be enough opportunity for the lenders also. And also when it comes to the entrepreneurs also, they will actually not feel the pinch of it. And there would be enough demand for the project loans. This is what I believe. And also, when it comes to infrastructure, happens to be the major lever of growth. And considering the kind of headwinds which we are seeing from the global environment, perhaps this is one area where we need to continue to have a focus. And I think keeping all that in mind, this revised norms will be very encouraging.
One of the points which has been mentioned in the final proposal is where the consortium of lenders are there, less than 1500 crore, 10% each share should be there for lenders, and similarly, if it is more than that, meaning more than 1500 crore, 5% each share should be there for all lenders. Do you think this kind of sharing or understanding among lenders was already there, or will it have more detailing now?
No, I think in a way it is good because having many more lenders also at times create quite a challenge in terms of ensuring that everybody comes around when it comes to the critical decision making. So I think on that particular count, this is a very welcome step which has been taken. This was in the past, it was more like informal understanding, but yes, of course, now it has been enforced through a regulation, so which actually is actually quite good, and will also ensure that there is enough stake on the part of lenders to really devote sufficient times in terms of sanction, control, follow-up, etc. So this is something which actually will go a long way, and also will also ensure that when it comes to the borrowers, they will have a limited number of lenders to really deal with, and which will actually cut on their time spent while engaging with various lenders.
All right, Mr. Khara, thank you so much for joining at this hour.